Everyone is talking about the income tax cuts in the new 2026 tax law. The tips deduction, the overtime deduction, the bigger standard deduction. But nobody noticed the page buried at the back. The one that quietly added a floor to your charitable deductions. The one that permanently erased an entire category of deductions you have been taking for years. If you give to charity, or if you've been deducting investment management fees, you need to watch this. I am Marcus. This is Macro Finance, and today we are going to find the fine print in the One Big Beautiful Bill. The One Big Beautiful Bill Act, OBBBA, was signed on July 4, 2025. Public Law 119-21. $5 trillion in tax provisions over 10 years. Here is what most of the coverage was about. The law made permanent the tax cuts from 2017. It gave a tips deduction, up to $25,000 of qualified tips free from federal income tax. An overtime deduction, a new $6,000 deduction for people 65 and older. Raised the cap on state and local taxes from $40,400 in 2026. That is the headline. Now, here's what was buried in the fine print. Meet Sarah, 47, marketing manager, Chicago, $95,000 a year. She gives to her church and the local food bank every year. She has a financial advisor who manages her taxable brokerage account, and she thought she knew what her 2026 taxes would look like. She was wrong about two things. Part 1. The charitable deduction floor. Here's the first thing nobody told Sarah about the new tax law. Starting January 1, 2026, if you itemize deductions, your charitable donations are only deductible above a floor. That floor is 0.5% of your adjusted gross income. Let me show you what that means in real money. AGI, $80,000. Floor, $400. Your first $400 of donations this year, not deductible. AGI, $100,000. Floor, $500. First $500 of donations, gone. AGI, $200,000. Floor, $1,000. First $1,000 of every year's giving, not deductible. Sarah's AGI is $95,000. Her floor, $475. She gives $3,500 a year, church and food bank. Under the new law, only $3,025 of that $3,500 is deductible. The first $475, disallowed. And unlike medical expenses, if she gives less than the floor, nothing carries forward. The tax cost, $475 at a 22% marginal rate, about $104 more in federal income taxes from her charitable giving, every year. Now, before you call this purely bad news, there is a flip side. For the first time, non-itemizers can now deduct charitable cash contributions, up to $1,000 for single filers, $2,000 for married filing jointly, starting 2026. So, if you take the standard deduction and you give to charity, you can now get some benefit, but not for donor-advised funds, cash contributions only. For the first time, non-itemizers can deduct charitable gifts, but itemizers now lose their first $500 to $1,000 to a new floor that wasn't there last year. Part 2. The vanished deductions. Here's the second thing nobody told Sarah. Remember miscellaneous itemized deductions? Investment management fees, tax preparation fees, unreimbursed employee business expenses. From 2018 through 2025, the Tax Cuts and Jobs Act temporarily suspended these. Millions of taxpayers were waiting for 2026 when they would return. They are not returning. The OBBBA made that suspension permanent. These deductions are gone forever. What specifically can you no longer deduct? Investment management fees, the fees you pay your financial advisor on taxable accounts. Tax preparation fees. Unreimbursed employee business expenses. home office deductions for W-2 employees, union dues. Sarah pays $600 a year to her investment advisor. Under the pre-2017 rules, that was deductible. Under 2026 rules, $0 deductible. Not temporarily, permanently. There is one survivor, educator expenses. But here's the catch. In 2026, educator expenses move from above the line to Schedule A, which means if you take the standard deduction, you lose the educator expense deduction too. You expected these deductions to come back in 2026. They didn't. The fine print made their death permanent.
Part 3. Who wins, who loses? Let me be clear about one thing. Most people are paying the same or less in taxes under the OBBBA. The standard deduction is higher. The brackets are permanent. But the law is not equal for everyone. Here are the clear winners. Tips workers. Up to $25,000 of qualifying tips now free from federal income tax. Overtime workers. Up to $12,500 for singles, $25,000 for couples of overtime, tax-free. Seniors 65 and older, $6,000 per person in additional deductions no matter if you itemize or not. High SALT states, New York, California, New Jersey, SALT cap rises from $10,000 to $40,400. Non-itemizers who give to charity, $1,000 to $2,000 deduction for the first time. And the quiet losers. Itemizers who give to charity, first 0.5% of AGI in donations, not deductible. Investment account holders, advisory fees on taxable accounts, not deductible, permanent. Consider whether fees inside an IRA or 401k make more structural sense for your situation. W-2 employees with unreimbursed work expenses, permanently not deductible. Highest earners, 37% bracket, deduction value now capped at 35%. RBC Economics called this a barbell effect. Capital-intensive businesses and higher-income households win on one end. Tips and overtime workers win on the other. The middle of the distribution, it gets complicated. The headline said, tax cuts for everyone. The reality is a barbell. Some got wins, others got quiet losses they'll discover at tax time. Part 4. Your 2026 Tax Playbook. There are 4 decisions you need to make before December 31st. Decision 1. Standard deduction or itemizing. The standard deduction in 2026 is $32,200 for married couples, $16,100 for single filers. Only 14.2% of taxpayers will itemize this year. That is less than 1 in 7. If your total itemized deductions, mortgage interest, SALT, charity, medical, don't clearly beat these numbers, take the standard deduction. Decision 2, your charitable giving strategy. Remember the 0.5% floor. Consider bunching. Concentrate several years of giving into 1 year, and this spikes your itemized deductions above the standard, and then you take standard the next 2 years. Or a donor-advised fund. Contribute a large amount in 1 year, deduct it all, distribute to charities over multiple years. Investment accounts. Advisory fees on taxable accounts not deductible, permanent. Consider whether fees inside an IRA or 401k make more structural sense for your situation. Decision 4. Are you claiming what you're actually owed? Tips and overtime workers, make sure your 2026 return captures the deduction. Seniors 65 and older, that $6,000 per person deduction comes off your AGI automatically. High SALT state residents, $40,400 cap makes itemizing newly attractive. Before you assume your 2025 strategy works in 2026, run the numbers under the new law. The standard deduction is now $32,200. Most people should start there.
Part 5. 3 moves before December 31st. Move 1. Run the itemize versus standard calculation. Get your mortgage interest statement, your property tax bill, your charitable giving total, your medical bills. Add them up. Compare to $16,100 or $32,200. If you're not clearly above, take the standard. Stop itemizing. Move 2. Consider charitable bunching this year. If you give $2,000 to $3,000 a year and barely itemize, give 2 or 3 years of donations in 2026, you'll clearly exceed the standard deduction this year. Take the standard in 2027 and 2028. Same total giving, better tax math. Move 3. Claim what you earned. Tips workers confirm the deduction is captured, either in your withholding or your 2026 filing. Seniors, the $6,000 extra deduction per person doesn't require itemizing. Take it. SALT payers in California, New York, and New Jersey recalculate itemizing with the new $40,400 cap. You may now be an itemizer again for the first time in 8 years. The law changed. Your strategy needs to change with it. 3 moves before December 31st. The One Big Beautiful Bill had a headline, and it had fine print. The headline, Tax Cuts, Bigger Standard Deduction, No Tax on Tips. The fine print, a new floor on charitable deductions, permanent deletion of the miscellaneous itemized deductions, and a tax code so complicated that only 14.2% of Americans will even bother to itemize. Sarah ran her numbers. She is switching to the standard deduction, but she opened a donor-advised fund to manage her giving more tax efficiently. Now you know the fine print. Act before December 31st. Hit like if the charitable floor was news to you. Subscribe because tax law keeps adding fine print. And comment, did you know about the 0.5% charitable deduction floor? I am Marcus. This is Macro Finance, and we will see you in the next trap.